Welcome to Part 6 of Sonoma County's 12-part Insurance Requirements for Contracts training program. In Part 6, we're going to discuss two general liability insurance concepts. The concept of ongoing versus completed operations, and we're going to talk about the way policy limits are in a general liability policy. Okay, a general liability policy covers both ongoing and completed operations. Ongoing operations, hazard to insurance techno junkies, are injuries or damages that happen while the party is doing the work or the job. So, an example, most common example, would be contractors. So I'd like you all to imagine that your building is getting rewired. And the county has hired my favorite electrical contractor, Sparky's. Okay. If while Sparky's is doing the wiring, something goes wrong and there is a fire. Fire is a tough word to say right now in Sonoma County. I know, there was a fire and property is damaged or people are injured. That is an ongoing operations claim. For contracts that don't involve doing work for us, like licenses, permits, leases, well, injuries or damage that happen during the term of the lease, those are all ongoing operations claims. Completed operations claims are claims that happen after the work is done or after products are supplied that cause injury. So let's go back to Sparky's. So Sparky's has rewired your office. The job is done. And however, Sparky's didn't do such a great job. 6 months after the job is complete, there is an electrical fire, and it is directly attributable to Sparky's lousy wiring. People are injured, property is damaged. To Sparky's, that is a completed operations claim because it resulted from their work and it happened after the work is done. Now, I always want to point out that the injury or damage has to occur during the policy period. What we will find in another segment of the training is that with respect to completed operations coverage, we often ask them to continue the coverage for 1 or 2 years afterwards because of the fact that injury or damage stemming from their faulty work could happen after a year later, 6 months later, 2 years later. The contractor actually has to warrant their work for a certain period after. But many other contracts don't have warranties. So we require this completed operations coverage to be continued after the job. And another example of that is the products, because the hazard is called products and complete operations. Products hazard results from injury or damage caused by your product after you've relinquished it. So an example of a products claim, if we hire a company to provide food for inmates in the jail, once they deliver and we distribute that food, that to them, that is a products completed operations claim because people, if the food is no good, obviously people get sick because the injury or damage happened after they relinquished it. And when we talk about additional insured endorsements, we will get into this, that we would ask for something like completed operations coverage to be continued for a year or 2 years into the future. And no, we cannot get evidence of that now. There's no way that we can do that because insurers issue policies only for a year. So all we can do is contractually obligate them to do that, but you can't get it in advance of the contract. It's just not possible. You'll find the same thing is also going to happen with professional liability when we discuss that as well. Okay, speaking of professional liability, I did want to point out one thing to you. The coverage for a consultant or a healthcare professional or a design professional, which would be errors and omissions coverage, is not completed operations coverage. It is professional liability. It is not covered by the general liability. We're going to find that in some way it works the same. We're going to require them to have professional liability coverage going on into the future, but that's not subject to general liability insurance. GL does not cover professional liability or errors and omissions. Okay. The other thing that we want to talk about is limits. GL policies have a number of limits. There are two basic kinds of limits in a general liability policy, and we want to talk about what they are. They're called aggregate limits and occurrence limits. An aggregate limit is essentially the most the policy will pay in the policy period, regardless of the number of claims, claimants, incidents, accidents. When I used to train insurance agents, I would describe an aggregate limit as a bucket of insurance. So if policy has a $2 million aggregate, you got $2 million in your bucket. Every time there's a claim, it comes out of the bucket. If the bucket gets empty before the end of the policy period, you ain't got no more. We call that having an exhausted limit. The limit is exhausted. Now, or we could explain it another way. We could say that an empty bucket or an exhausted limit, the person who bought the policy is SOL. SOL is a technical insurance term. Means surely out of luck. Surely. Okay. Now, a general liability policy has two buckets or two aggregates. One is called a general aggregate, and one is called a products completed operations aggregate. Remember, we just talked about the difference between ongoing and complete operations claims. Claims that are products or completed operations, as we just discussed them, come out of the products completed operations aggregate. It is possible to exhaust that limit during the policy period, which means it's not going to pay any more products completed operations claims. However, you may still have general aggregate limit that's not exhausted, so ongoing operations claims, other claims would be paid. The general aggregate covers all other claims, or I should say all other claims come out of the general aggregate that are not products completed operations. All of the claims from premises use, license use, permit use, and ongoing contracting operations, those claims all erode the general aggregate. So we got two buckets of insurance. Now, occasionally, you will get evidence of insurance from some party that doesn't show an aggregate at all. Typically, that will come from another public agency. That's the most common. It's not always, but typically from another public agency. Good news or bad news? Good news. Good news, yes, absolutely, good news. It means that the policy, that you can never empty the bucket. There's no aggregate. So it's not, if the evidence of insurance that you get doesn't show an aggregate, you say, hallelujah, thank you very much. Now, we got these buckets, but you don't take everything out of the bucket like this. You take it out with a scoop. That's what the occurrence limit is. It's a scoop. In other words, and the scoop applies per occurrence. It's kind of like per incident or accident, being very general about this. We might require a $2 million aggregate, but a $1 million occurrence limit. So for every accident or incident or occurrence, the most they're going to pay is $1 million. So they might have a $2 million aggregate. There could be an incident that involves injury or damage for $1.5 million, ain't going to get paid because you can't take out something out of that bucket that's bigger than the scoop. Okay, does that make sense to everybody? We always require an occurrence limit of at least $1 million for most high-risk projects, particularly construction. We tier our limits because large construction projects, we're going to want larger limits. Just a word about defense costs. Defense costs, because not only do they pay damages, but these policies also pay defense costs, because if there's litigation, part of the claim is paying to be defended and all of the court and legal costs. Those are almost always in general liability insurance outside the limits. In other words, they are not limited by the occurrence limit. They're not limited by aggregate limits. So they're unlimited outside of the policy limits. So are we responsible for checking how much they've got left in their bucket? No, you're not. Not only that, you can't. It is impossible to check. Because if you actually were to read the policies, limits are technically eroded by paid claims. So there can be a whole lot of incidents that occur during the policy period, but liability claims sometimes drag on for a year, 2 years, 3 years, 5 years. They're not paid claims. And so the insurer doesn't even know. Now, the insurer reserves amounts that they think, but a reserved amount doesn't technically reduce the policy limits. In fact, I once read some attorney who did plaintiff work against insurance companies. He involved his plaintiffs to settle fast before the other plaintiffs. Because when the limits are gone, the limits are gone. Excellent question. Okay, that concludes part 6 of Sonoma County's insurance training program.